Welcome everybody. This is the Fishhook Trader, James Nash here, and we're going to be doing an audiobook of the Fishhook Trader, Trading for Beginners, Options Basics. Today is June 25th, 2019. In the background you have Amazon feeding live on the 1-minute chart. We're looking at the slow downfall. Market closes very shortly here, so we'll try to get this book through, and I hope you guys enjoy. All right. Are you a new trader? Do you want to learn about the stock market? I am writing a series of books dedicated to getting you started. Most importantly for this book, it is all about options trading. Options for Beginners takes you through all of the basics and some of my personal experiences with options trading, including my secrets to trading options and my 4 rules specifically for them. If you're ready to indulge in the world of making money you did not know existed, open up. The Fishhook Trader, written and distributed by James A. Nash. The Fishhook Trader, Trading for Beginners, Options Basics. Disclaimer. I am James Nash, own intellectual rights and property to these works herein. Options for Beginners. First and foremost, let us just go over one simple thing, the disclaimer. So as you know, this is an educational source and not to be misconstrued as any type of financial advice or guidance. You do with your money what you think is best. I am no guru or financial advisor. I simply am sharing my opinions and outlooks along with my personal experiences in the market. You can lose all of your money or you can make a lot of money. Nothing in this reading or other training educational materials is to be taken as guidance to do something or take action. Do not risk money you cannot afford to lose. Past gains are not guaranteed and should not be expected as such in future results. Thank you. Enjoy. Give a quick little picture of that. Feel free to zoom in, screenshot, etc. There you go. All right, page 1. What you need to know about this book. This book will take you through the basics of options trading from calls to puts. No, I'm not referring to calling someone or putting something on the shelf. However, those are 2 references of words of traders who trade options tend to use, and what you will almost always see on a trade screen. You will buy an option or sell an option on an underlying asset. Chapter 1. What is an option? What is an option? An option is a contract between 2 parties that is matched by the market or option clearinghouse or broker. The definition by Wikipedia is option contract. An option is the right to convey a piece of property or underlying asset. The person granting the option is called the optioner or grantor, and the person who has the benefit of the option is called the optionee or the beneficiary. Options have different characteristics and exist in one of 2 forms. Call options, which give the beneficiary the right to require the grantor to sell or convey the property to them at the agreed price on exercise. Put options, which give the beneficiary the right to require the grantor to buy or receive the property at the agreed price on exercise. Exercise meaning that the option is expiring and the action is being taken whether the options expire worthless or was exercised against you to purchase the stock. What is a call? A call is when you believe the stock or underlying asset will change in higher value, meaning the price will rise, thus fluctuating the price of the call option you bought, making you a profit. What is a put? A put is when you believe the stock or underlying asset will decline in price no matter the reason, thus fluctuating the price you either bought or sold the put at. What is a strike price? A strike price is the price at which you are selecting the stock will either be over a call or under a put by a certain date, which is the expiration. Things to look for. There are a few things you need to look out for when trading options specifically. First, you need to be aware of the strike price you are trading. That is not too far from the current price. If you trade a strike price that is too high above the current price and you don't have a lot of time to hold that trade, say if the expiration is a few weeks away and you buy a call for Ford Motor Company at $19, but the strike price is only $9.50, you would be saying that the price of Ford would double in just a few short weeks. Now, I'm not saying that's not possible, because for some stocks it is absolutely. However, if you purchase a contract for that example listed above, and you're the only one who bought it, and the price is that far away, you're going to have a really hard time selling it to close your position to try and salvage some of the funds paid. If the option expires under your call, the option is now worthless and you don't have the position nor the money you bought it with. Now, what you can do is buy a call for Ford at $12 since the price is only a few dollars away. Say we do only have a few weeks and we buy the call for Ford at a strike price of 12. The cost of the option is 0.02. Now wait a minute. 0.2? 2 cent? Yes, 2 cent. The reason being is that you're multiplying that by 100 shares. So it is actually $2 per contract. One thing you will need to be attentive to is the fact that depending on what brokerage you're using to trade, you have trade fees. You will have the standard trade fee and the fee per contract. Brokerage trade fees range from $0 to $8.95. The contract fees generally range from 0 to 125. Chapter 2, Options, Volatility, and Scalping. So you have your Ford option call for October 19th, 2018. We bought 205 contracts at 2 cents or $2. That is a very large position, controlling a massive amount of shares leverage. This position would have cost of $405. Now, why would you buy that many contracts? Well, you wouldn't unless you knew for absolute sure that Ford was going to be over $12 on October 19th at the closing bell. If you're wrong, you will lose all of your investment. However, there is something else you can do that I love doing. It is called scalping, or in more professional terms, hedging. This is the act of protecting your profits by selling the position short. So you bought 205 contracts at 2 cents and the price went up to 3 cents. Because Ford stock is rising up to the $10 range, now you do have a decent chance to hold out and make the full amount, which will be insane if the price goes over. However, the full position can be sold short for quick profits if it is an option that has high volatility, which Ford does. So as long as the stock price is inclining upward, the limit sell to close this call option position for 0.03 or 0.04 and get out. Put it this way, if you went for 0.03, you made a 50% return on investment. If you went for 0.04 and got out and all the contracts sold, then you just doubled that 405. 100% is amazing, which is really not that hard to do when it comes to options with very high volatility. I understand that this can be confusing for some. However, once you grasp how this works, you'll be amazed at the opportunities you did not know were there. For example, if you feel that the stock price is going to rise and the stock also has high volatility depending on your type of option, that is, we will say, for example, a call on Ford. The stock and the options both have pretty high volatility on a daily basis. If you buy your call option at the money or ATM or ITM in the money, you will have a higher chance of profitability. You want it to be close to the strike price and the current stock price on a call with high volatility because the chance of your profit is much higher than buying an option that is way out of the money or OTM, meaning the strike price is quite a ways away. If you buy it too far out of the money or OTM, you will need a long-term, at least a few months buy call because you want to have time on your side, at least for a little while. Time in the option world is known as theta, aka time decay. Also, theta works against you as soon as you buy a call until it is over. You will not only need a longer term to hope for a nice incline of stock price, but you will also need that stock price to incline much closer to your out-of-the-money call option. Breaking down whether or not you want to buy or sell a call or put depends on the overall condition of the stock price. Not only the current condition, but the future condition. If fundamentals like a company profit and earnings per share or EPS are poor, then the chance of the stock dipping down in a bearish or downward fashion are likely. However, if the company is doing great and the EPS is good, as in positive, or less loss than the previous quarter or year, then you are in good shape for the majority of the time. Now, either of these can be a good tool for you along with the things like speculation and market sector condition, pending what route you want to take as far as call or put. Chapter 3, Risk Assessment and the Secret. How can I make consistent and highly reduced risk option trading? Well, I'm going to tell you this little secret, perhaps one of the most told secrets and most sold secrets that people really want to know. It is called selling a put. Wow, whoa. Do what? If you don't know anything about options or have heard anybody or read anything saying selling a naked put, then you may be confused. Yes, you were exposed to potential loss. However, That is why you pick stocks that are not going to tank or high volatility stocks. You want a stock that is consistent and moves as little up and down as possible. Now, if you're selling the put and the stock moves upward, then you really don't have anything to worry about. If the stock moves rapidly down, you may have to worry about the person exercising the contract against you. Exercising is where you sold a put and the stock the other person has that you agreed upon with the contract is going to be put to you because it crossed whatever threshold they had that they did not want their stock to go down below. Now, in the event that the underlying asset or the stock does not move down and stays the same for the consistent amount of time, then you will be paid the premium that you sold in the beginning, and your collateral being held for the stock option will be released to you scot-free and unscathed, and you will have just kept your initial premium payment received. The best part about all of this is that you keep the premium no matter what. Once the contract is agreed upon and matched by the options house, it is pretty much yours from the get-go. The only way you will miss out on the premium is if the stock fell below your break-even point, which is the price you agreed to purchase the stock at if exercised against you, minus the premium you received. Example given on the next page, Figure 1. Figure 1, the money for collateral equals number of shares represented by the contract. Selling a put example. Selling a dollar put on FSEL, 2 contracts equals $200 collateral cash that will be held until FSEL reaches your expiration designated. You offer up to sell this contract for the date and time and cost for a limit price of, let's say, $25. That means if someone wants to protect their 200 shares of FSEL for that 1 month period, then they will pay you $25 premium per contract, so $50 essentially up front, which will likely fluctuate until time of expire. Plus, you get the 200 released back to you in the end, or if you chose to buy back the contracts instead for early profit to just exit the position. You sell the $1 put on FSEL expiring November 21st, 2018. Say that it is only 1 month away, which is normally the time you want to sell a put because you want time or theta on your side. On November 21st, the contract will expire, and if the share price is above the $1, you will likely not be assigned the contract to buy the 200 shares of FSEL at $1. You will get back your collateral, and you will keep the premium you established to sell the contract for in the beginning. Selling a put, my 4 rules. Now, a few things to explain is that the way this works, you pick your stock based on a few factors. 1, the stock needs to be stable and have heavy average volume, like 300,000 to 500,000 and higher. This is going to tell you that the stock is nice and strong, or at least not moving rapidly up and down. 2, you want something that has a decent history and some time on the New York Stock Exchange or NYSE. 3, you want something you can afford to sell a put on. 4, sell the put for a short amount of time. The less time you sell it for, the faster you get paid. If you sell a put for 6 months, I sure hope the premium is worth it. You want at least a month, 1 month to make a pretty much guaranteed premium for holding your money hostage, while the other trader is just paying to protect their assets. They don't want to risk losing a nice position if the market does something crazy, so you were there to take off the worry. You also are going to want to own this stock if it does get put to you at this lower price, because it will likely go back up in value. And you got it at the all popular lingo of at a discount. So there you have it. The 4 simple rules of selling a put. Number 1, stability. Number 2, long-term good history on the New York Stock Exchange. Number 3, you can afford it. Not dirt cheap, just affordable. 1 month time frame for selling a put or less if you can. Buying a call. Buying a call, I personally find myself buying more calls than puts or selling puts just because the return on a high volatility stock is a much more rewarding effect. I have a few limits and rules regarding call options that can help protect from substantial losses. First, never buy too many contracts. I have bought 1 to 205 contracts. I can easily sell even all the way up to 50 contracts when the price is moving rapidly and traders are getting in and out of the stock very quickly, just as they do with small cap stocks that can make them a lot of money if they trade them frequently. Say, buy a call 4 months out for a 4-month term to expiration. In this, you will want some of the good volatility with the price dipping and then rising and steadily inclining of the price you got your option for. Say a $12 strike price for Ford Motor Company, and it costs you 0.03 or $3 because you multiply it by 100 shares. So, awesome. You spent $3. Now say you got 10 contracts controlling 1,000 shares. It would cost you a whopping $30 plus trade fee and contract fees. You hold these contracts for the day or a few days or a week and wait until they increase in price. Now you can use your rules or common sense or scalping. You can hold the contracts until expiration, where depending on your strike price chosen and the current price of the stock and how much time is left until expiration, you may or may not simply break even, make a small profit, or possibly lose all of the 30 you put in. Now, if the stock goes buck wild and shoots to the moon and goes up to $15, you can make some serious dough on those 10 contracts. Per se, the price 2 days before expiration shoots to $15 per share of Ford, and the strike was 12. It looks to be a very high probability that you will make your money and then some. At that price, just 2 days before expiration, your chance of making a nice return is probably around 70 to 90%. So your initial buy at 0.03 per contract could very well be at around the $1.10 to $5 range per contract, which, yes, that is a range from $110 to $500 per contract. Now, the only question is, will the price stay up that high and glorify you with a massive thousands of percent return? Maybe. It is as simple as that. We do not have a way of knowing. So the question of the day is, if you spent $30 on 10 contracts that are now worth between $110 and $500 each, are you really going to wait and see if you stay green until the buzzer sounds at the end of the expiration? Hell no. You need to set a limit order, sell to close, order just below the current market price, and your order will likely be accepted because you went below the current price, and you will get the price improvement. So from your $30, let us say you sold at 90 cents or $90 per contract because the stock price started to go the other way. You just made $900. How? Well, it is simple. Volatility and the expiration were in your favor, and the stock price or underlying asset soared, creating a beautiful opportunity. 90 cents or $90 per contract times 10 contracts is $900. That is an insane return. Guess what? You decided upon brains over stupidity, cashed out your position, and made off nicely. Guess what the stock price closed at expiration? $11.89. Therefore, your position would have expired and been worth absolutely nothing. Closing a position early. Good thing I'm here to tell you my story and throw some insight around. Maybe you won't feel like such an idiot. When the guy at work says he scalped $10,000 last month and you lost $10,000 because you tried to wait out the position and be greedy, or just simply did not know you could get out of the position early. This happened to me once, trading on Nadex binary options. Trading a Euro-US dollar pair and selling a put at $4 per contract. So with binary, I had 15 contracts. Therefore, $96 was in my favor per contract. I was up $678 profit on the trade. And I did not know I could buy back the position. Therefore, the expiration at 6 p.m. happened and I made zero. Plus lost my original investment because I did not know I could exit early. Something I really wish I would have known ahead of time. So now you know. You are able to exit a position early. Just like you can sell a stock early if you planned on a long position, but news or company fundamentals suffered and you started losing chunks of cash, you could then get out of the stock by selling it. Options are the same way. If you buy a call or put, you can sell the call or put to close the position. If you sold a put, you can buy the position back. Especially if you are in a good profitable position, it is likely in your best interest to close and scalp or take your profit early. Call options, my 4 rules. My simple rules I follow to utilize call options. 1, volatility. 2, quality stock with a nice volume being traded, typically 300,000 to 1 million volume. Number 4 months or longer to expiration, but not over 6. It's just too long. Scalp the position the moment you either double your money or reach a target percent between 15 to 40%. As soon as you see this, get out. If you chose to be greedy and let your winners run, you will lose. Likewise, closing your losing trades too soon can also cost you. hence why you would want a longer expiration. If you do the gambling phase of 1 week or 3 weeks or something silly, Theta will eat you for breakfast, take your lunch money, beat you up after school, and not think twice about it. Know this: Theta equals time. Chapter 4, Types of Option Strategies. Different stock option strategies. There are actually quite a few different strategies and legs that you can attain with stock options. Unlike just buying and selling stocks, buying and selling stocks, you literally only do that. You must buy it low and sell it high to make a profit. A leg is an addition to an already created option strategy. In simple terms, with options, it gets a little more interesting and you can mitigate risk very well. We kind of spoke about selling a put and buying a call. Here are some of the other positions, sometimes referred to as legs: a straddle, a strangle, an iron condor, a spread, a butterfly spread. These can all be utilized to make wonderful, consistent returns regardless if the stock goes up or down. Let us discuss these briefly. Straddle. A straddle is the simultaneous purchase of stock options to buy and sell a stock or underlying asset at a fixed price, allowing the purchaser to make a profit whether the price of the security or commodity goes up or down. This can reap massive benefits in a market moving in a volatile manner. A strangle. There is a long and a short strangle. The long strangle, aka the buy strangle, is a neutral type of strategy in stock options trading that consists of the simultaneous buying of a gently out of the money, or OTM, put and a gently out of the money, or OTM, call of the same stock and expiration time. The short strangle, aka the sell, the short strangle strategy requires the seller to simultaneously sell both a call and a put option on the same stock. The strike price for the call and put contracts must be decently above and below the current price of the underlying asset. Strangle versus straddle. The difference between a straddle and a strangle. Straddles and strangles are both option strategies that allow an investor to gain from significant moves either up or down in a stock's price. The difference is that the strangle has two different strike prices, while the straddle has the same strike price. Iron condor. An iron condor is an option strategy that utilizes two vertical spreads, a put and a call spread with the same expiry time and 4 different strike prices. A long iron condor is basically selling both sides of the stock by simultaneously shorting the same amount of calls and puts, and then covering both positions with the buy of higher out of the money, or OTM, calls or puts. The opposite becomes a short iron condor. To short an iron condor by selling, the trader will buy the long position or option contracts for the closer strikes using an OTM put and OTM call. Then the trader can also sell or short the option contracts for the farther OTM strikes. Spread. Option spreads are the base layers of the majority of option strategies. A spread is created by buying and selling an equal number of options of the same type, call or put, on the same stock but with different strike prices or expiration dates. Butterfly. This is a neutral strategy which is a combo of a bull spread and a bear spread. Bull stock expected up, bear stock expected to go down. It is an all-around limited profit and limited risk strategy. There are 3 strike prices opened in a butterfly spread, and it can be built by using calls or puts. Options can put you into a world that makes small returns much larger. Being in the money, or ITM, or at the money, ATM, is an option can have significant returns. Study your stock. Choose the best option for your position, call or put, and make a good decision using all the signs you need to. Technical analysis, fundamentals, news, etc. will help you make the right choice. A little movement in the right direction and liquidity, which is being able to get rid of the position quickly if you choose to scalp or hedge, is very important. Learning information resources. Great movies and books to watch and read or listen to these days with audio versions of most to gather intel on market habits and things that happen. I will soon publish another book about trading penny stocks and general stock investing. Remnants of a Stock Operator. Stock Market Rules, 3rd edition. The smartest investment book you'll ever read. Investing for Beginners. Movies to mention: The Big Short, Wolf of Wall Street, both versions, the 87 and 2010, and The Pit. The end. Happy trading. Take control of your financial future. It is a must. Get out of the system that breeds us to work for life. What you are missing is in the clouds with the rest of the rich and the wealthy. Quote by James Nash: mind over matter and results over resignation. The end. I do hope you all enjoyed this read of The Fishhook Trader, Trading for Beginners, Options Basics. You can come listen here, or you can get your own copy on Amazon and look it up by The Fishhook Trader, Trading for Beginners, Options Basics. And you'll find it on Amazon for around $10. Thank you for listening.